Hello and welcome back to week two, chapter three. This week it's going to be a little bit different. We're going to have the PowerPoint during my presentation, and during the presentation, you'll also be able to follow along with a chapter three or chapter four integrated case. So I will talk about this integrated case, this integrated case as we go through the PowerPoint. So you'll notice at some point that I start talking about the balance sheet for DeLeon's Inc. That is part of the presentation. Please have the chapter 3 case on your screen. Same thing with chapter 4, chapter 5, and as we continue on through the rest of the term. So here we go with chapter 3, week 2. We're going to talk about chapters 3 and 4 this week, financial statements. So a brief overview of financial statements. We have a balance sheet. That's a point in time. That would be as of 12/31, as of 6/30. Then we have the income statement. That's over a period of time for the year ended 2024, for a quarter, for a month. Statement of stockholders' equity. This is a change of time. Statement of cash flows. The change of cash over a period of time. We have free cash flow, economic value added or EVA, and market value added or MVA. And then we're briefly going to talk about the federal tax system. So the annual report. The annual report, that's what we think of when we think of publicly traded companies. We have the balance sheet, a snapshot of a firm's financial position at a point in time. So it'd be like the amount of cash you have on hand on 12/31. The income statement summarizes a firm's revenues and expenses over a given period of time. This might not be cash, this is how much money you've spent on an accrual basis if you're filing reports. The statement of cash flows reports the impact of a firm's activities on cash flows over a given period of time. So you can spend your cash or you can still have expenses where you haven't spent cash. Think of that credit card. Companies can borrow either from banks, individuals, vendors, um, without having to pay money. Same thing goes for income. You can provide services, and maybe your customers have 30, 60, or 90 days to pay you for that. So you've earned the money, but you haven't received the cash. Statement of stockholders' equity shows how much of the firm's earnings were retained rather than paid out as dividends. So now is where we're going to start using that chapter 3 example. So an overview of DeLeon is a snack food company that underwent major expansion in 2020. So far, expansion results have been unsatisfactory. The company's cash position is weak. That means they're spending more than they're getting in. Suppliers are being paid late. That's not good. Bank has threatened to cut off the credit. That's real bad. The board of directors have ordered that changes be made. And remember, the board of directors oversees the CEO, and the CEO takes care of the day-to-day operations. So here's a look at their balance sheet. You can see that their cash went from 57 to 72. Their accounts receivable went up, so we have less money and we owe more money. Our inventories went up tremendously, so we have a bunch of inventories sitting around. That's not good. That's cash waiting to get into our system, which we could use to pay our accounts receivable. This is total CA's current assets. Our total current assets went up tremendously, mostly in our inventories and our accounts receivable. Our fixed assets went up tremendously. Our depreciation didn't go up very much, so that tells me that we added fixed assets, and our total assets nearly doubled. We keep on going down. We look at our liabilities, accounts payable. We owe more money. People owe us. That's what this accruals is. And notes payable, we borrowed money. So our long-term debt is now 723 versus 323, went up 400,000. Our common stock did not change, so we borrowed money to buy stuff. Our retained earnings was only 32,000, and our total equity is 492. Total liabilities and equity 2.8 from 1.4. Our retained earnings went down 170,000, so we lost money last year. Here's our income statement. You can see here our sales went up tremendously. Cost of goods sold went up tremendously. Other expenses, depreciation, earnings before income taxes was down. Earnings before taxes, since we made no money, we have no taxes, and we actually lost 160 versus making 109 last year. We'll have to dig into it a little bit more and find out why we're losing money, because it looks like our sales went up tremendously. Our cost of goods went up tremendously. So where are we losing money? Our number of shares did not go down. Our earnings per share went down. And our stock price went down tremendously. Here's some more of our statement of stockholders' equity. 100,000 shares worth 460. Earnings, equity. You can see this 492. It matched up to our balance sheet. A stockholders' equity of 492 at the end of the year. So our net income, statement of cash flows, our net income, you start with that, negative 160, depreciation and amortization, add an increase in accounts payable, add in our increase in accruals, subtract out our accounts receivable, increase in inventories, and that's the net cash provided by operating activities. Operating activities are what you do every day as part of your day-to-day activities. Investing activities, here's where we spend a lot of money. You can see here we invested in property, plant, and equipment. 700,000 going out the door. And we paid for it by borrowing it in notes payable and long-term debt. You can see here we also paid out an $11,000 dividend. Our net decrease in cash was 50,000, which ties to our balance sheet. Remember, we had beginning cash of 57.6, and our cash at the end of the year was 7,200. So DeLeon's financial condition from statement of cash flows conclusions. Net cash from operations was negative 164, mainly because of negative net income. The firm borrowed $836,000 to meet its cash requirements. Even after borrowing, the cash account fell by $50,000. And we saw most of that borrowing was to add to property, plant, and equipment. Net working capital versus net operating working capital. Net working capital is current assets minus current liabilities. Net operating working capital is operating current assets minus operating current liabilities. So just to break that out a little bit further, you can see it's current assets minus excess cash minus current liabilities minus notes payable. And you might be wondering, why do we have net working capital versus net operating working capital? We're going to start talking about different formulas and different equations that paint a picture of how a company is doing. Not one of these equations is the end all be all. Some people will tell you that it's EBITDA or it's net working capital. No, you have to look at all of these and do trend analysis to figure out how a company is doing and what it's doing good, what it's doing bad, what it can improve upon. So, DeLeon's case, did the expansion create additional after-tax operating income? So, after-tax operating income is earnings before income taxes times 1 minus the tax rate. So we have a negative 38 times 0.75, which equals negative 28,000. So after-tax operating income is 142,821. What effect did the expansion have on net operating working capital? Net operating working capital is current assets minus excess cash minus current liabilities minus notes payable. So we take the 1.9 minus the 7,200 minus the 1.6 minus this. So our net operating working capital actually went up about 120,000 from 2020 to 2021. So actually net operating working capital went up after we did the expansion. Sales went up tremendously. After-tax operating income was actually down for the year. Net operating working capital went up, but net income went down tremendously, almost 270,000. So here we have free cash flow. Here's the formula for free cash flow. Free cash flow was a negative 74, 744, 564. So is negative cash flow always a bad sign? Not necessarily, because remember we added property, plant, and equipment. That about equals that. So, performance measures for evaluating managers. Accounting statements are insufficient for evaluating managers' performance because they do not reflect market values. So there's other values that we can, other formulas we can do to measure the performance of the managers. So going back to DeLeon's, we added a bunch of capital. We lost money this year. Is it really that bad? Are we having a bad year this year, knowing that we're going to have a good year in future years? We spent a lot of money to improve things at the factory. Maybe we're taking too short term of a look at the numbers. So, market value added, MVA, difference between market value and book value of a firm's common equity. Economic value added, estimate of a business's true economic profit for a given year. So market value added was actually a negative 267 compared to 2020. Shareholder wealth has been destroyed. It's not good. If economic value is positive, then after-tax operating income is greater than the cost of capital needed to produce that income. Positive economic value added on an annual basis helps to ensure market value added is positive. Market value added is applicable to the entire firm, while economic value added can be calculated on a divisional basis as well. So MVA is the entire firm, EVA is a part of the firm. Did DeLeon pay his suppliers on time? Probably not. AP increased 260% over the past year, while sales increased by only 78%. If this continues, suppliers may cut off DeLeon's trade credit. Does it appear that DeLeon's sale price exceeds its cost per unit sold? No. The negative after-tax operating income and declining cash position show that DeLeon is spending more on its operations than is taken in. It's getting a little bloated, or it's not selling enough. One of the two. What if DeLeon's sales manager decided to offer 60-day credit terms to customers rather than 30-day credit limits? Accounts receivable would go up. Cash would probably go down. If competitors don't match and sales double, the short run, inventory and fixed assets have to increase to meet sales, while accounts receivable and cash have to go down. So then we have to borrow more money. But in the long term, we might get more collections and the company's cash position might improve because now companies can pay us slower so they can keep their cash longer. How did DeLeon finance expansion? It borrowed. We saw that from the very beginning. It borrowed long term and short term. Would DeLeon have required external capital if they had broken even in 2020? Yes. They invested $712,000 in fixed assets. They would not have made enough money to cover that. What happens if DeLeon's immediately expenses qualify business assets rather than depreciate them over a longer term? No effect on physical assets. Fixed assets on the balance sheet would decline more quickly. Net income would decline in the year the assets purchased. Tax payment would decline in the year purchased. Cash position would improve. So that's why you hire a tax accountant to look at those things and help you decide how to do it. Real quickly, we're going to talk about individual taxes and corporate taxes. Corporate and personal taxes are both set up as progressive. The more money you make, the more you pay. Don't take this stuff as gospel. Tax law changes every year. Individuals, it goes as high as 37 to 42% now. Nebraska does have state tax. If you borrow money personally, you can write some of it off. Businesses generally don't. And this is dividends. Most of the time you pay 15% when you have dividends, but it depends. Hire a tax attorney once you start getting into the stuff. Here's some additional tax issues, tax loss carryover, capital gains. If you have something for a long time, you pay 15%, and then single taxpayers with higher income generally pay 20%. All right, that's chapter 3.